This is the Daily Market Rundown live from the Tradelo trading floor. It's July the 3rd. Some highlights from today's show. Long bonds are poised to move up. Bitcoin is ready to take off and non-farm payrolls is now in focus. Good day traders and welcome, a happy Thursday. This is of course perhaps the final trading day for most of you. Don't forget we do have a little bit of an early close in some of the CME products today, given we do have July 4th tomorrow. Now I'm going to start off and talk a little bit about July 4th just to set the expectations for today. Okay, one of two things is going to happen today. If the non-farms comes within a range, what it means is us as day traders are going to be switching off relatively quickly. Okay, and it's important to stress that because today's not the day that anyone from an institutional perspective is going to be taking risk unless they're forced to play. Okay, this is the key. If we get a negative number on non-farms, fine. Positions are going to scramble. We have a repricing event, and unfortunately, institutions are going to get stuck in, and we're going to have quite a happy or quite an aggressive session. Okay. If, however, we come within a range, 10 to 15,000 of the expectation, we're going to have a pretty damp squib session, and it's important to stress that because you don't want to be getting involved if the markets are going to be mostly sideways, given the fact that we're now going into a long weekend. Okay, with that in mind, let's get across and talk about our first topic of today, and it's of course all about that big beautiful bill. It made its way through the Senate. It's making its way through the House. Seemingly, it's going to be passed. I'm not going to go through it in great detail, but what I do want to point out is this bottom part, just to actually now start to look at the implications of this bill. Because sometimes as traders, of course, we can kind of get sucked into what the charts are doing in terms of, based on the big beautiful bill. But in reality, there's a few things that this big beautiful bill does do, and this is the part to talk about. Now, what are the main parts of it? Well, the very first one, and I think probably the biggest part of this, is the extension of the 2017 tax cuts. Okay, now why does this matter? Because I think you have to kind of work back to front here. You have to think of it from a standpoint of, had this not been extended, it would have effectively put the US economy perhaps into a recession. Okay, they would have pulled or effectively just overnight taxed everyone much higher. That takes obviously demand out of the equation, and of course we know currently the US consumer is relatively weak. Okay, so had they not extended those tax cuts, ultimately it probably would have put us in a recession. Now this doesn't necessarily mean that everyone all of a sudden has more money in their back pockets. It just means that the money that is in their back pockets is not suddenly going to be taken away. Okay, so that's the important thing to stress. It's not sort of a sudden flush of cash into the economy. It's perhaps just sort of an extension of what we already had. Okay, now we do know some of Trump's sort of giveaways in terms of people keeping their tips and all of that. Fine, there'll be a little bit of a stimulatory effect from that, but again, at the margin, it's not sort of a significant boost to the economy. Okay, we also know that some of the healthcare and food net programs, those have been cut, and again, that's of course some savings. Now that will ultimately have some impact, but again, not significant impact in terms of GDP at the end of the day. Okay, we then move on and look at some of the other things. Of course, some of the green energy initiatives that were taken out by Biden, those have been scrapped, so perhaps a bit more fiscal prudence there. But ultimately, what has happened is we know that the government has now effectively increased the ceiling by about 5 trillion. Okay, so what this means is that the US government can continue along the lines of 6 to 7% deficit spending without having to get obviously approval from Congress again. Now, all of this, what does it point towards? Well, it points towards a US government that can keep on spending. It's not to say that they are going to just suddenly come out and put money in people's pockets. Ultimately, there is going to be quite a bit of fiscal spending going on, and this is ultimately why the markets are seeing this as positive. Okay, net to net, whenever you have fiscal spending, it's always going to be positively impacting GDP. Okay, and this is why the stock markets are at record high. They're looking at this big beautiful bill, they're seeing it as only stimulatory as opposed to what it could have been had they not passed it. Okay, and I think that's the key takeaway is, had they not passed it, I think we would have had some form of a recession. The fact that they are passing it means perhaps the likelihood of a recession does get diminished even further. Okay, now with that in mind, I think one of the key things to lean on and to start looking at now is the bonds, because we know that given this is going to be fiscally not necessarily irresponsible but expansionary, we know this is going to be the third year running now the US government runs a 6 to 7% deficit. We know that investors are nervous at the long end. Okay, and so we as traders have to be watching that long end. Now, we've been talking about this 30-year pretty much all year, and we're going to keep talking about it all year, because at some point, this 30-year bond is going to make its way back up to that 5%. Okay, now why are we looking at the 30-year? Why are we going that far out? Well, because realistically, the deficit of a United States government is a problem, but it's not a problem perhaps today, this week, this month, this year. Okay, it's a long-run problem. At some point, it's going to be a problem. Now, it might not be now. Sure, of course, it's very topical and it's very much part of the narrative now where the US government's being irresponsible. But Japan was irresponsible for, 30 years effectively, and they never got punished. Okay, the point is that debt is only a problem if you can't service it. Okay, and right now the US government can service it, and so we have to just keep that in mind. Now, what does matter ultimately, and I think where we do need to pay attention, is what the bonds are doing, particularly the long bonds, because what we can see on the weekly chart is we can see effectively that 30-year bonds are just not pulling back. And when I say just not pulling back, they're just not pulling back even relative to where we were, of course, in Liberation Day tariffs. Okay, so if you go back to the Liberation Day tariffs, it started around that. Of course, we initially saw yields move lower, and then they moved up. Okay, now note, if we started Liberation Day tariffs around 460, we're currently trading 480. The long bonds is one of the very few markets that's not retraced the Liberation Day tariffs. Okay, why? Well, because effectively investors are telling the US government that you're not being prudent enough. Ultimately, we don't want to perhaps hold your debt at these yields. We demand higher yields. And in essence, if you're going to run, of course, higher deficits, we are going to want a higher risk premium for that. Okay, and so this is the key, is that ultimately the fact that this is the one market that hasn't yet retraced those Liberation Day, it really does point to how sensitive the bonds are now, and in particular going forward. Okay, what I want to point out, of course, this big beautiful bill is going to pass. What I would say is keep a very close eye on how the bonds close out this week and perhaps close out this month. I do expect if the non-farms does come out strong today, or if the data starts to improve in the US economy like I expect it to do, if we start to get a reacceleration, we are of course going to see those long bonds move higher. Moreover, and this is important to stress, and we'll talk about this in the next topic, we know there's a lot of pressure on Powell right now to cut. We know President Trump wants him to cut aggressively. In this context, where long bonds are right now, should Chairman Powell cut prematurely without fully getting inflation under control, you will see long bonds make their way very quickly back up to that 511. Okay? Does this matter for risk markets? No, not necessarily. We talk about rate of change. The absolute level clearly doesn't matter. Otherwise, we wouldn't be at record highs. But at some point, it may begin to matter. Okay. Moreover, what we can see is right now the US curve, if we look at the 2s, 30s, we can see the US curve has more than doubled in terms of the steepening. In other words, we continue to see the steepener theme, and importantly, it's very much a bear steepener. Okay, and at some point this will matter. At some point risk markets are going to stage a fright. But right now, like I said, it's about the rate of change. We don't yet have that rate of change. Should Chairman Powell be forced to cut prematurely? Fine. Should Chairman Powell get the sack over this weekend? We know he's under pressure right now from Congress, and obviously we're just one headline away from perhaps President Trump firing him. The reality is, should that happen, should Fed independence be called into question, not only will we see this curve steepen very aggressively, we'll of course also see a number of other implications like a weaker dollar and of course risk market sell-off. Okay, keep an eye on those long bonds. I think that's the key takeaway. Now, our second theme is all about the money supply. This is topical. It's going to become more topical. This was already out last week. There's a lot of people that follow this very closely. And this is a chart doing the rounds. Sorry, it's a little bit blurred, but this is a chart that's doing the rounds. And it's effectively looking at global M2 liquidity, as well as, of course, the price of Bitcoin. Okay, Bitcoin effectively lags M2 money supply somewhat. And of course, we know that an increase in the M2 money supply just means there's a lot more money in circulation. Now, there's a number of reasons why there's more money in circulation, but net, this is not really what the Fed wants to see at a time when, of course, they are conducting QT, at a time when, of course, they've got interest rates elevated at 4.3%, and at a time when, of course, they're trying to get inflation back down. Okay, this is not what the Fed wants to see. This can prove to be problematic for them because it means there's not sufficient amount of restriction on the demand side of the equation. Okay, now, again, there's a number of reasons why M2 money supply is rising, and again, we have to be very careful trying to draw any kind of conclusions around it. But one thing's for sure is that Bitcoin is very sensitive to money supply. Of course, it's one of the core theses as to why you own Bitcoin. It is effectively a hedge against the devaluation of currency due to higher inflation. Okay, so I think given the fact that now M2 money supply is at record highs, don't be surprised to see Bitcoin, or at least the narrative around Bitcoin, start to shift. Okay, with that in mind, we spoke a little bit earlier this week about this chart in Bitcoin. We spoke about it prepping itself for that breakout. We saw an outside day yesterday on some really decent volumes. We took out almost 7 sessions in one go. Effectively, we closed outside that trend channel. So again, what does this mean? Well, it definitely tells us there are some buyers, very aggressive buyers, that started buying yesterday. They're still interested today. And I think the key now for Bitcoin, very important, there's one thing sort of holding Bitcoin back right now, and I think it's just the non-farm payrolls. Okay, should the number come more or less in line, and we'll talk about numbers and ranges in a minute, but should it come more or less in line? Should it beat? Okay, Bitcoin is off to the races. Should we get a big number today in the Bitcoin? Should we get a big number in terms of the non-farms today? It's going to start to point towards a re-acceleration of the US economy. Obviously, Bitcoin is going to be a very strong benefactor of that. Okay, so keep a close eye on that. Technically, it's broken that trend channel. It's still got a lot of work to do. Okay, don't forget there are some weak longs now, weak hands. We don't really want to see Bitcoin get back below that 108 level. If it does, okay, the plunge protection team is going to be in very quickly. We are going to make our way back down towards the bottom of that channel. Okay, but the key takeaway is we close above 110 today. That record high at 112 is going to come in view very quickly. And I suspect this time around we're not going to stop there. Why? Well, because we're seeing a lot of money in the system. It's now starting to chase the likes of Russell. Okay, if you've been watching this week, you'll notice the switch over where they're moving out of tech into a more broadening of the rally when Russell starts to lead. And of course, some of the meme names start to lead. You really have to switch on and pay attention because it does showcase a bit of a broadening of the rally. Okay, so that is key. If we are going to see a broadening of the rally, if we are going to see the Russell continue to outperform, guess what? Bitcoin is going to be a massive benefactor of that, and we are going to see some speculation come back into that. Okay, keep an eye on that. Definitely want to pay attention to. Now, this was an article, very interestingly, I think it's worth a read. On Reuters, and the key takeaway is that obviously they were asking a whole bunch of reserve managers at central banks their views based on obviously Donald Trump's presidency, some of the decisions he's made. And I think there's one thing that sticks out very, very interestingly, which, and again, this is a survey, this is people's opinions, but ultimately 35% of 40 central banks. So they looked at 40 central bank reserve fund managers and they asked them a whole bunch of questions. And 35% of those 40 managers said that they are concerned that the US might ask their allies to convert longer term debt into other instruments such as ultra long zero coupon bonds. Okay? What does that mean in basic English? Well, if you're a central bank and you hold US debt, okay, and you hold whatever 30-year debt at 2%, the US government in essence can come and tell you they're going to do a swap and they are going to give you 100-year bonds at 0%. Okay, and effectively, yes, there are some legal ramifications, but in essence, they can do that. Okay, now ultimately, if that's a fear you have, if that's like a real fear that people have, you've got to ask yourself, where's the demand going to come from for US debt moving forward, particularly long debt? Okay, 1-year debt, 2-year debt, fine, it matures relatively quickly, you get your money back pretty fast. 30-year? Who's going to own 30-year debt in this sort of context? And I think this matters a lot because what it shows is, and what it's pointing towards, is a distrust or a real concern around ultimately what comes next in the obviously the US presidency. So this is not going to go anytime soon, and what this does reinforces some of the themes of sell dollar, of move out of the US into alternatives. Now, this is not something that's going to happen overnight. We're not going to see the dollar slump 50% this year. It doesn't work that way. Okay, at the end of the day, the US dollar is still the supreme currency. It's still the reserve currency. But what we are going to see is the likes of gold that has outperformed over the last 2 years. That's not going to go away anytime soon. Okay, because reserve managers have to put money somewhere. And if they want to rely less on the US, ultimately that money's got to go somewhere. Where's it going to go? Well, the likes of gold will do well. The likes of the euro will do well. The likes of Swiss franc will do well. The likes of Chinese renminbi will do well. The likes of Bitcoin will do well. These asset classes are going to do well simply because there's perhaps less of a dependency into the future on the United States, given the concerns that managers have. Okay, very, very interesting article. And then, of course, it does go on to say that over the next 5 years, reserve managers reckon the euro will benefit the most, followed by the renminbi and crypto assets. Okay, again, it's a survey. It's people's opinions, but I think the key takeaway is that there is a real concern, and guess what? It's not going away for the next 3 and a bit years, because obviously that's how long the current sitting president will be there. Okay, interesting one. And then with that in mind, of course, let's move on and talk about non-farms. It's the highlight of the day. Let's get stuck into it. Like I said, I think let's start off with the obvious. The expectations for today is a 106 number. You can see it there. So it's 106. That's what's expected. I think a number of 90,000 to around 120, you can pretty much switch your screens off after a half an hour, go home and enjoy your long weekend. Okay, that is the range, I think, where we will fall within some degree of expectations. Why? Well, because guess what? This is going to be one of the first reads now where we should see the full effects of the Tariff Liberation Day series. Okay, that's the key, is that it's sort of now or never. Everyone that's thinking there's going to be the slowdown as a result of tariffs, well, guess what? You're going to need to see it now. Okay. Equally, those calling for U.S. companies that were holding on ultimately beyond the uncertainty will also either be vindicated or proven wrong today. Okay. The point is we're going to find out a great deal today. Either the U.S. economy kind of sailed its way through the tariff situation and everyone just kind of ignored it, or ultimately there were some layoffs. Now, if it comes within 90 to 120,000, switch your screens off, go home, don't waste your time, and ultimately make sure you long Bitcoin into the long weekend. Okay, this is the kind of number range which will have very little impact on the rates markets. Okay, now we have to talk about the rates markets, because right now, going into this meeting, or into this print, the July meeting is pricing in, roughly speaking, call it 7 basis points. Okay, call it around a 1 in 4 chance of a rate cut at the July meeting, which is in about 4 weeks. Okay, so ultimately there's some expectation they could cut, but if the number comes from 90 to 120, that expectation is ultimately not going to change a great deal. Now, if it leans above 120, okay, let's say we get a 135, and this is an important number to keep in mind. Why? Well, because it's the 3-month average. Okay, 135 is the current 3-month average. You get a print of 135 today at a time when ultimately there was a fear that we're going to get a slowdown. Guess what? Your July cut is off the table. There's no chance of a July cut. Okay, so the markets will respond a little bit hawkishly to that. You'll see the bonds offer a little bit. And like I said, in particular, you'll see the long bonds offer quite a bit on that. And importantly, I think you'll also see the dollar stage a little bit of a bid. Okay, we know the dollar has been weak for some time. And I think the one risk to the dollar now is a reacceleration in the US economy. Should we see a reacceleration, don't forget that dollar has got a lot of short positions in it. And ultimately, there's a lot of rate cuts priced into the US dollar. So any reacceleration, you are going to see dollar shorts come unstuck. Okay, so that's kind of how you have to look at 90 to 120. Don't bother, don't waste your time. 135, ultimately, that's a pretty solid print. The risk markets will love that. Equities up, Bitcoin up. Bonds will probably initially sell off and then find a little bit of a range. But ultimately, 135 and above, okay, all bets are off. This idea of, tariffs slow down the economy, recession, blah, 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 forget all of that. It's gone. Okay, we will see a reacceleration to the second half of this year. And the markets need to start pricing in that reacceleration. Don't forget that equities are at record high for a good reason. Markets are getting ahead of ultimately the big beautiful bill. They're getting ahead of ultimately the reacceleration that they think might be coming, given the US economy looked beyond the tariffs. Okay, now again, all of this is speculation. These tariffs could have had a big impact, and it could be just waiting in the background. So it's not to say that it won't be the case, but right now we need to, of course, just look at the data points. Now, what numbers move the needle on the downside? In other words, what numbers bring forward a rate cut in July? Okay, because right now, Jerome Powell told us earlier this week he wouldn't rule out a July cut. Okay, so what numbers bring into play a July cut? Well, what we have to look at is we have to go back a little bit to last year and look at these 3 prints here. Okay, this was effectively into the August print where we had 3 really soft prints below 100,000. Why does 100,000 matter? Well, because this is effectively the number that Powell thinks we need to maintain to keep the unemployment rate from ticking higher. Okay, we had 3 prints in a row to the downside below 100,000, and we all remember how the Fed cut 50 basis points in September. Okay, they panicked, they cut 50 basis points, and then the economy reaccelerated. This time, however, I think the key takeaway is, should you get a print below 70,000, okay, that is going to move the July cut odds up to at least 50-50. Okay, so again, how will that work? Well, you'll see, of course, the front end of the bond market blip up a little bit, and then it will kind of just oscillate. Okay, because a 70K print, 75K, it's not good. Okay, perhaps we will see the unemployment rate tick up to 4.4. Markets will stage a little bit of a fright, but then don't forget, this was ultimately the impact of the tariff situation, and we know the tariff situation is ultimately getting better. Okay, so the Fed is not going to panic over one print, but the markets will want at least a 50-50 chance of a July cut. Okay, ultimately we get a sub 50,000. In other words, you get a less than 50,000 print. Okay, all bets are off. I think you can pretty much bank on the fact we are going to get a 25 basis point cut in July. What that means is further dollar weakness. What that means is, of course, the front end of the bonds are going to bid up, because not only are they going to price in July, they're going to price in more in September, and ultimately we will, of course, see quite a bit of movement in the bonds. Okay, so that's the sort of the expectations for today. That's the sort of range. Something above 135 is really solid. Something below 70 is going to have some impact on the rates markets. Below 50, and ultimately we are going to get quite a decent move in the rates markets. Let's talk about some of the outliers. What about a number greater than 200,000? Okay, well, 200,000 ultimately is going to very much call into question not just July. I mean, July gets ruled out completely. Ultimately, it also now starts to call into question the September meeting. And again, I think a number greater than 200,000, your best bet, buy some dollars. Okay, dollars is very oversold. A number of 200,000 is really going to start to point to re-acceleration in the US economy. And right now, the best place to go and present a trade is go long the dollar. Okay, for a couple of days, you can be long dollar, and you can pretty much trade it against any of the currencies. Okay, and if we then go and look on the downside, what about a negative number? Okay, in my career, I've never seen a negative number, so it would be nice to see a negative number just for some shits and giggles. But yeah, negative number, all bets are off. Not only will the market price in 25 basis points for July, it'll probably go a little bit further. Okay, we'll probably see it try and price in, call it 35 basis points, so almost at 50 basis points. Not only that, a negative number, they're going to pretty much price the Fed to get to neutral relatively quickly. Okay, so I think the next 3 meetings, bringing the interest rates all the way down to neutral, somewhere around that 2.5% mark. Okay, so around 150 odd basis points of cuts, so 50, something along those lines. Okay, negative number. Also, as a trader, it's not something that you do just for a couple of hours. It's a trade you'll have on for a couple of days, and that will include the likes of short equities, long particular front end of the curve, and then of course very much short the dollar. Okay, that is of course then the non-farm prints. In terms of the unemployment number, the actual percentage, it's expected to tick up today for 4.3. We're still some ways off the SAM rule being triggered, but like I said, it's expected to come in around 4.3. Should we get a 4.4 number again? I think that's going to create some concern. We know that did scare the Fed last year. It was when we had 3 months in a row of 0.1 unemployment tick up every single month. So yeah, we get a number up to 4.4 today. Again, we are going to start to call into question perhaps the Fed being behind the curve. Now, with that in mind, one final note, don't forget, Chairman Powell is in the hot seat right now. There's a number of calls for him to ultimately face a review given lying to Congress. Should the number miss today, I do expect you're going to see the president piping up again on late Powell, on moron Powell, and all these sorts of things. And his rhetoric may stiffen a little. I think the key takeaway is, should you get a bit of a miss to the downside, don't be surprised to see the president calling for an investigation into Powell. Okay, so I think that's one outlier that perhaps we may get today, where there's sort of a gap for the president to call, just for perhaps getting rid of Powell a little bit sooner. And again, there will be implications if that was the case. We will of course see equity markets stage a bit of a fright on that as the Fed's independence gets called into question. Okay, there's your scenarios. There's a number of things that can go on today. It could be a nothing day. It could be a something day. Our job as traders is to see the data, prepare for the data, and execute on the data. That's our job. That's your job. And like most importantly, like I said, if the number does come in more or less within that range, that 90 to sort of 120, don't be fighting today. It's not the day to do it. We've got a lot more work to do next week. And then finally, with that in mind, for all those in the United States, enjoy your July the 4th. I don't know much about it. All I remember about July the 4th is the movie Independence Day and aliens and all that sort of stuff. So yeah, have a good July 4th and obviously recover, and we will come back next week and we start all over again. Any questions, do post in the Discord channel. Otherwise, good luck out there. Manage that risk, go make some money.